The major tech companies are currently spending hundreds of billions of dollars competing for a single, finite resource: electricity. Training frontier AI models requires massive campuses capable of drawing hundreds of megawatts of power, and hyperscalers are willing to pay a heavy premium to anyone who can deliver it. Enter NUAI Energy and Digital, a company pitching itself as the solution to this bottleneck. But look closely at their corporate history, and you'll find that their identity as an AI infrastructure developer is only about 8 months old. Before the summer of 2025, NUAI was a microcap fossil fuel operator. Their primary business model involved extracting helium and operating legacy natural gas wells across the Permian Basin in southeastern New Mexico. Those operations did not yield the intended results. By the end of fiscal year 2025, their legacy gas wells produced a mere $885,000 in total revenue. While the core business struggled to generate $1 million, the cost of pivoting the company's entire identity caused expenses to surge, resulting in a staggering $29.6 million net loss for the year. NUAI is now attempting to construct the multi-billion-dollar digital infrastructure of the future, entirely financed by the remnants of a failed natural gas venture. The financial strain became even more apparent when the company filed its first quarter earnings report. In just 3 months, the cash burn accelerated, generating a net loss of nearly $9 million as the company poured money into professional fees, land preparation, and debt servicing. Looking at this balance sheet, the table details a devastating working capital deficit. The total current liabilities have stacked up to $57.9 million, heavily outweighing their near-term assets. At the exact same time, external pressures began mounting. A prominent short seller named Fuzzy Panda published a highly blistering report targeting the CEO's track record, which quickly triggered multiple securities class action lawsuits. These compounding issues forced their independent auditor to attach a going concern qualification to their filings, a direct warning that the company might not have enough cash to survive the next year. Without an immediate and massive injection of capital, NUAI will exhaust its financial runway long before it installs a single server rack. To pull out of this dive, management placed their entire focus on a single make-or-break development called the Texas Critical Data Centers Project, or TCDC. The physical reality of TCDC is an empty 438-acre field of greenfield land located just outside Odessa, Texas, in Ector County. This diagram outlines their core strategy: behind-the-meter power generation. Instead of drawing from the public grid, they plan to install natural gas generators on site, feeding electricity directly into the data center. In Texas, the ERCOT queue is backlogged 3 to 5 years. Generating power on the customer side bypasses that queue entirely. To execute this, the company needs to source and install massive industrial gas turbines capable of producing 450 megawatts of electricity, requiring complex air quality permits and significant water rights. If they can successfully pair cheap West Texas land with immediate on-site gas power, they solve the hyperscaler's speed-to-market problem, creating a highly lucrative asset. Initially, NUAI didn't even own this entire project. It was structured as a 50-50 joint venture with a company called Sharon AI. In January 2026, NUAI completed a corporate restructuring, buying out Sharon AI's entire stake to consolidate 100% ownership of the TDCD campus. Consolidating that ownership came at a steep price. To fund the buyout, NUAI issued a massive $50 million senior secured promissory note. This debt carries an aggressive existential deadline. The note matures rapidly, coming fully due on June 30th, 2026. When that deadline arrives, the company will need $50 million in cash. As of their Q1 filing, they hold exactly $2.2 million. Securing full control of the campus gave NUAI all the potential upside, but it also saddled them with the catastrophic risk of default if they fail to find institutional backing. Every operational milestone at NUAI is now entirely subordinate to the race to refinance that $50 million note before the end of June. To handle this, the company hired Ted Warner as their new chief financial officer. Warner brings 2 decades of capital markets experience, specifically in structuring multi-billion-dollar data center financing. His explicit mandate is to unlock a massive $290 million credit facility from Macquarie. This facility would pay off the looming note and provide the construction capital needed to actually build the site. In their investor presentations, the company uses this slide to project confidence. They list the Macquarie credit facility under a funding pathway established chain to convince the market they are ready to execute. Despite the optimistic presentation, finalizing this specific credit facility remains the singular bottleneck standing between the company and insolvency. If Warner misses the June deadline, the company defaults, and the entire gigawatt vision falls directly into the hands of the debt holders. If the financing does clear, NUAI survives to fight another day. They can break ground on Phase 1 construction and officially begin hunting for a tenant. To guarantee long-term revenue, they have to finalize a joint venture with their development partner, Primary Digital, and sign an anchor lease with a major hyperscaler. This line chart illustrates the brutal binary of their financial forecasts. If they secure the tenant, revenue scales exponentially through 2028. If they fail, the company flatlines. Building physical infrastructure on this scale demands years of continuous, massive capital deployment before the first servers are ever plugged in, let alone generating cash flow. NUAI is navigating the ultimate high-wire act. They have positioned themselves for massive upside in the AI infrastructure boom, but that entire future is currently balanced on the edge of a ticking $50 million debt clock.